All right, so today's video we're going to be focusing on iron condors and how to trade them in Webull. I'm also going to break down how they work, what they look like, what to look for, so you know how to do them on other platforms as well. I just feel like Webull breaks it down the simplest, right? So to hop right into it, you're going to go open Webull, choose a stock. Yeah, you choose a stock. You're going to see this little button up here, and this gives you a ton of different options, trading strategies, right? So you have single option, yeah. You got your straddles, your strangles, your butterflies, your condors, etc. Right? We're going to iron condor today, yeah. So like I said, Webull breaks it down for you pretty simply. Um, when I was first starting off, I'd always have to double check to make sure I was doing the right thing or buying the right put and selling the right put and etc. So anyway, we're gonna open it up. By the way, this is the ask price. This is the mid price of these four contracts, right? And then you have the bid price over here. Uh, you can't click the mid price, so you're gonna have to click the one of the ask or the bid. Anyway, you're gonna want to change the price to uh, the mid price, which is in this case 119, right? All right. So currently we're on a short iron condor, right? And what that means is that we are going to get for these 10 contracts a net credit of 1,190. Yeah. Um, And what this consists of is selling one put and one call that are at the money and buying one put and buying one call that are out of the money. Yeah. If you wanted to change it to a regular long iron condor, you can just click here, go to buy, right? You're buying it. Basically, that means it's a debit. So you're paying the 1,190. And that's trying to leverage implied volatility to make money, right? But you're going to the sell side, you're getting this credit. This is what will be credited to your account. Yes, this is the most you can make, the absolute most, right? All right. So anyway, we're on Apple here, right? And let's just go break down leg by leg what this means, right? So we're buying a put, 10 contracts of a put for 180. And then we're selling a put for 182.5 strike. We're selling a call for 185, and we're buying a call for 187.5. With a short iron condor, you want it to stay in between these two for the best results. It can stay between these two as well. Sometimes you can make money on that. Sometimes, it's basically just to minimize risk on how much you're going to have to pay back, right? Because the farther it gets away from these two, yeah, in either direction, it's going to cost more to buy that one back. Yes, and that's what you have to do at the end of the contract. You will only get this if it expires worthless, right? But if in a week, let's just say that, all of these go down like 10%, right? So we're going to make 1,100. We're going to make 1,000, or sorry, $119. Yeah. Um, so yeah, you're selling the put and the call that are closer to the money. And you're buying the put and the call that are farther out of the money, because this is the two that you're selling going to be the premium, the difference in between the buying and the selling. And then later you have to buy back these two and sell these two, if that makes sense. This is a way to minimize risk while trading. And again, high risk, high reward. This is a lower risk for a lower reward, right? So you can change the quantity here, change the limit price, again, the side, if you want to do long, short iron condor, etc. Right? So, all right. So currently, Apple's at a price of 182.4. Yeah, and here we have a put that's at the money. That's 182.5. So Apple's already in the money for this, right? Uh, One call that's at the money, kind of, which is 185. Then we have one put that we're buying for 180, which is a little farther at the money. And we have one call that we're buying, which is 187.5, which is a little bit farther at the money. Now, here's the thing with condors. Like I said, you want it to stay in between these two prices for the best results. A stock like Apple, it's extremely risky, which is why you're making $1,000 literally in 3 days. Yeah. Pretty much guaranteed if it ends up between 182.5 and 185, right? Thing is, a lot of time Apple won't do that. If you think it will, you can. And even if it does it for just one day, right? Like I said, theta will kill it, and theta is the time decay of stocks. So every day, these options will decay further and further, right? So, they may lose, like I said, 10% a day, 20% a day, whatever the theta may be. Yeah. Um, so again, Apple's extremely volatile. So this is a tricky iron condor, right? Let's say Apple goes down to 180. You're gonna have to buy back these two, and this put is going to be a lot more expensive than it was. The call will not be. Again, this is how you minimize risk because you're buying on this side. It won't be that expensive. Yeah, but the put will be. Okay, so anyway, basically what you want to look for is something that's not that volatile. The thing is, again, stocks that are not that volatile do not have high premiums on their contracts typically, right? Especially cheaper stocks. Yeah. So one that I used to do um, is Verizon, right? So here we got the Iron Condors. So you open this up, right? And again, Verizon's price currently is 39.31, and so it's already in the money for this put as well, right? And this is you could see compared to Apple, which was $2.50 difference between the two cells. This is just 50 cents, right? But you can also see for 10 contracts, you're only making 290, which is about 20% of what the Apple was. Again, less risk, sure, but a lot less credit. Um, One thing I didn't show you about the Apple that you could do, of course, if you want to change these four strikes, which you can on Webull, because it gives you the options here, obviously. But if you want to change them to, mix and match them for what you think Verizon is going to stay between, because let's say for the past year that Verizon's been, staying above 35, and we'll do for the cell, we'll do 37 because it has a decent amount of premium, right? It's actually not nothing at all. It's extremely cheap. This is what I'm saying. The safer you get, the less money you'll make, but it's more guaranteed. So this is pretty much a guaranteed 60 on Verizon. Um, Let's see. So for the call side we'll do 43, 38 and a half. Now that premium shot up. Holy shit. Oh, because it's already in the money. Duh. My bad. What am I doing? We'll do 41. Right. So again, more safety. I was like, what the fuck? I was tripping myself out. So 41, a lot safer. Verizon, moves maybe 50 cents a day. And so by Friday, you will have a guaranteed 40, right? If you wanted to, you could, buy 20 contracts, guaranteed 80. Pretty not guaranteed. I shouldn't say guaranteed. But, again, low volatility, less premium, further out, a wider spread between the contracts, a lot more safety, and it's more likely that you will get this premium. Um, So yeah, again, look out for low volatility. That's what you want to look for in stocks. Look for trends. See what a stock's been staying in between, right? And then set your two cells you're calling your put that are at the money or around the money um, at those prices that you think it will stay between. All right, so that's pretty much it for iron condors and short iron condors. If you have any questions, leave them in the comments below. I'll try to answer as many as possible. We do have a Discord group for options alerts. So if you're interested in getting alerts daily to your phone, push notifications, we do a lot of scalping, a lot of swing trades. There's also just a lot of information that you can learn, a lot of cool people to talk to and ask questions to. It comes with one-on-one help. We're working on getting our own trading view indicator and a bunch of other stuff. So if you are interested in that, um, please join the link below. And yeah, guys, trade safe, stay safe, and have a good night. All right.